Hello and welcome to Fitch's virtual investor meeting on European CMBS. Fitch has one-on-one meetings with hundreds of investors each year, and we want to give you a glimpse inside these meetings. My name is Susanne Matern and I'm the European Head of Structured Finance Ratings at Fitch. With me today I have Euan Gatfield, the head of our European CMBS group. Welcome, Euan.
Hi.
Euan, we have quite some exciting developments in the CMBS market in Europe. We have seen a genuine pickup in deal activity. I think this year we have already seen 4 transactions pricing versus just 1 compared to the same period last year. And the pipeline is still building. So what types of deals are we seeing and how are they typified by particular asset types or jurisdictions?
Yeah, we're seeing most traditional commercial real estate property types represented in this recent uptick in issuance. So office has been in the frozen deal. We've seen retail coming through Italian transactions in the form of shopping centres. But the real, I guess, uptick has been in the industrial space. So logistics, last mile logistics are featuring quite significantly in deals and also in the pipeline going forward. Where CMBS tends to work pretty well is in markets where the banks are less active. So that's one reason why Italy has come back in this recent uptick again. The banks there are heavily laden with NPLs and CMBS is a viable channel for financing. We're also seeing some operating assets coming into CMBS, notably the Ribbon transaction that's recently priced had hotels in it in a UK portfolio. We've seen UK student housing featuring in transactions, and we know that there's some inquiries in that regard. One of the interesting things that we're expecting perhaps to come into CMBS is in the private rental sector. So traditional housing in response to demographic trends that are happening across Europe with more rentals and a requirement to finance them. So we're seeing inquiries. We're just on the verge of expanding our criteria to cover this sector, PRS. So that's one to look out for.
Okay, from what you just said, a key asset type we have seen traditionally in UK, especially shopping centres seem to be missing. So why is that? Do you expect any issuance, or are the headlines on UK retail sector having an impact here? And if yes, is that only impacting new issuance activity or also existing transactions?
So we do have some legacy exposure to UK shopping centres, and you're right to say that the retail sector is currently, undergoing a bit of turmoil in the UK. It's not really translating yet into performance on the deals that we rate, which are destination shopping centres. So the super regional centres that have performed reasonably well since the crisis. I mean, UK retail generally has struggled to bounce back since 2007, 8, 9. But the destination centres, much like prime assets generally, are the ones that have certainly performed better and bucked the trend. That being said, with a number of large retailers in difficulty, and each day there's new headlines. This, we think, will start to come down on those prime shopping centres as well, as they have to deal with tenants moving out, and I think it's an opportunity perhaps for other tenants to renegotiate rents down, and we're seeing a bit of tension, I think, right now between landlords and retailers over the use of CVA. So our view would be that rents are likely to sort of soften in the next kind of phase of the cycle. We've built some headroom into our ratings in view of that. So that's not something that we're overly concerned about in terms of our current exposure. One interesting possibility is that as these headlines sort of mount, it's possible that banks themselves will become less keen on the sector in terms of lending and refinancing. We know refinancing is quite challenging. So it could be that CMBS actually becomes one option, as I mentioned earlier, where banks are less interested than CMBS has shown that it can kind of fill that gap. So we wouldn't be too surprised to see UK retail return in CMBS at some point.
Now moving back to the new deal activity we have seen, Have there been changes in the debt structure versus prior vintages, or is there anything worth highlighting in your opinion?
It's kind of well publicized, and there are some concerns around the loosening of loan covenants. Not something that troubles us too much, it has to be said. We focus more on cash flow and hard events of default. And actually what's interesting is where in recent transactions where the loan financial covenants are not present, we're seeing them essentially replicated at the structure level, at the note structure level. So, if LTVs tick up above certain thresholds, even if the loans don't have those covenants, we're seeing excess spread trapping mechanisms at the CMBS level. That's a genuine innovation. Other loan features, LTVs have been ticking up a little bit, although that's probably plateaued around 70% max typically. Structurally subordinated mezzanine facilities are pretty commonplace. We are broadly neutral on mezz when in terms of our ratings of the CMBS, the senior portions. There are a few wrinkles there. So where we think the mezz has perhaps too much insider power, for instance, with open-ended purchase options or last look provisions on the properties, then we may take a notch down from break even to reflect that extra power they have. One positive thing I'll point out is we were concerned a couple of years ago about too much dynamism built into property release pricing. So as properties are sold out of portfolios, we were seeing a trend where the release price that borrowers have to repay to the lenders was being recalculated after every sale, which makes it extremely complex to analyze. That seems to have fallen by the wayside, so we're seeing more simplicity return on that feature, which is pretty important from a rating perspective.
So that was loan level. What about note level?
So I mentioned one thing, which is the notes are featuring this excess spread trapping in certain circumstances. Probably a trend that we're sort of monitoring is it seems like the norm right now that fully pro rata structures are being adopted, which I think does mark a little bit of a further development since prior transactions, which often had modified pro rata 50-50 between sequential and pro rata. So that is a little bit more aggressive, reflects how competitive the CMBS has become. Low margins are tightening just as note margins are, so it's more attractive to go with pro rata structures. That makes it for us more relevant to look at individual asset idiosyncrasies, something that we recently commented on. But perhaps one innovation that we saw in the frozen transaction worth pointing out was the use of a rated super senior note to fund the liquidity facility or the liquidity reserve. But we're seeing on the waterfalls, and another slight technical point would be where principal and interest waterfalls that have traditionally been quite separate, we're seeing them increasingly combined after loan default. And what that allows is loan penalty interest upon loan default to be recaptured as principal, which is quite useful.
So what you've just described is what we have seen recently, new trends. But looking forward now, what are your expectations near term and midterm?
Perhaps one deal a month would be a good result. The difficulty in making projections is that in recent periods of volatility, CMBS has been one of those asset classes that has seen spreads blow out and a hiatus in issuance. So, if there is that vulnerability, perhaps still, and so we're monitoring how some of the volatility we've seen in recent weeks, whether that has an impact. If it doesn't, then I think, as I say, one deal a month is probably a viable issuance level that wouldn't come up against any bottlenecks in the market. Part of the difficulty is it's very much a single loan product, and so pricing loans versus notes is very critical to make the business model work for the banks that are doing these deals. And if markets do widen in terms of spreads, then the pipeline can back up, and quite quickly banks are losing money. So that's the sort of the challenge, I think. One way that might, in the medium term, kind of balance out a bit is is if debt funds that are ramping up using warehouses, if they use CMBS to scale up and refinance, this is a bit more patient capital, and naturally they can time the market a little bit more opportunistically than the banks that are sitting on single priced loans. So if that comes into CMBS, we're having a few inquiries, then that might sort of help steady the ship through volatility on note pricing.
Thank you, Euan, for sharing your thoughts, and thank you all for joining us. For more on our series of virtual investor meetings, please go to our website fitchratings.com/virtual. Here you'll find discussions with other European asset class heads, as well as with our colleagues in North America and Asia. If you have any questions, please send us an email to the address on your screen. Thank you very much.